Hello. This video has been designed to give guidance to taxpayers and their agents on Revenue's Compliance Intervention Framework and the Code of Practice for Revenue Compliance Interventions, which is effective from May 2022. The information provided in this video is general guidance and may not be relevant to the facts of an individual case. Further information is available on Revenue's website. Revenue's mission is to serve the community by fairly and efficiently collecting taxes and duties and implementing customs controls to fund the exchequer. Self-assessment is the basis of our taxation system. It is the responsibility of every taxpayer to comply with their tax and duty obligations, and the majority of taxpayers voluntarily and diligently discharge this responsibility. Revenue recognises that taxpayers may, on occasion, make mistakes in their tax affairs, and we provide extensive facilities to enable taxpayers to voluntarily address errors and make good any liabilities with minimum penalty. Revenue may carry out a compliance intervention if a general or a specific risk to the tax system is identified. There are different levels of compliance interventions, which are based on the type of risk identified and taxpayer behaviour. Level 1 compliance interventions are used by Revenue to remind taxpayers of their file and pay obligations and to assist them in getting their tax affairs right. Level 2 and Level 3 compliance interventions are used by Revenue to make an inquiry where potential non-compliance by a taxpayer has been identified. The Code of Practice for Revenue Compliance Interventions provides you, the taxpayer, with certainty and clarity around the opportunities available to you to voluntarily address any issues you might identify in your tax compliance. A taxpayer who finds that they have a tax default can avail of these opportunities, and they will experience the minimum level of penalty and generally not risk either publication or prosecution. This Code of Practice is a written document, and it explains what a taxpayer can expect from Revenue if we contact you in relation to your tax affairs. It outlines a taxpayer's options to regularise their tax position should they need to do so. It shows the benefits to a taxpayer of disclosing any default at the earliest opportunity and of cooperating fully with the Revenue intervention. It gives details of how and when penalties apply for different categories of default. And it explains your entitlement to review or appeal if you are dissatisfied with either the conduct or outcome of a Revenue compliance intervention. A new Code of Practice for Revenue Compliance Interventions is effective from May 1st, 2022 and applies to all compliance interventions that are notified to a taxpayer after that date. The Code of Practice applies to all taxes and duties except customs and includes all forms of withholding taxes, including applicable interest and penalties. The Code of Practice explains the compliance intervention framework that Revenue will operate from the 1st of May 2022, and this document is available on Revenue's website. This informational video is designed to give you some of the key points that are contained in Code, and we recommend that you read the Code in full, should you believe you may have need to do so. Revenue's Compliance Intervention Framework is a structured set of interventions that are consistently applied to ensure that Revenue responds to any detected risks in the tax system. Level 1 compliance interventions are in the supporting compliance space. Level 1 compliance interventions may be used where there is a general risk and the aim of Revenue is to assist a taxpayer to be tax compliant. There are many types of activities which fall into Level 1 of the Compliance Intervention Framework. For example, Revenue might write to a group of taxpayers who are in receipt of a particular source of income, such as rental income, and request them to self-review their affairs to ensure that they have met their tax obligations. Likewise, Revenue may write to a group of taxpayers who have not yet filed their annual return of income and self-assessment to remind them to do so under a Level 1 compliance intervention. In other situations, we may require supporting documentation in connection with a refund claim, and we may write to the taxpayer to request this information using a Level 1 compliance intervention. Revenue will progressively respond with appropriate vigour to taxpayers who do not comply voluntarily or change the behaviour that has given rise to their tax non-compliance. In these circumstances, where we detect a risk that is specific to a taxpayer, we may initiate a Level 2 revenue inquiry. In these cases, our aim is to inquire into the potential non-compliance by an individual taxpayer. The revenue inquiry will be conducted as either a risk review or a revenue audit. Where serious tax or duty evasion or fraud is identified, revenue will initiate a Level 3 revenue investigation. Revenue encourages all taxpayers to conduct a regular self-review of their tax affairs. Self-assessed taxpayers are required by law to keep accurate books and records. A taxpayer should ensure that accurate tax returns are filed and paid on time. Where revenue initiates sector-specific self-review programs or issues a notification of late filing, a taxpayer should act promptly to ensure that they are tax compliant. If a taxpayer finds that they have a tax default, they may either self-correct a return they have made subject to certain conditions, or in other situations, it may be more appropriate or advantageous to that taxpayer to make a disclosure of their tax default to revenue. A taxpayer may self-correct a return they have already filed. If the correction of the return is done within a certain time frame after the due date for the return, no penalty is incurred. If the correction is done outside the time frame for self-correction without penalty, a penalty may be applied in certain cases. In all situations of self-correction, the taxpayer must notify revenue of the details that have been corrected. Notification can be done in writing to the relevant office or through Ross or My Account. The additional liability, if any, should be paid in full at the time of the self-correction. Taxpayers are directed to Section 2.2.1 of the Code of Practice for Revenue Compliance Interventions for details on the time frame for self-correction without penalty for each tax head. The other way a taxpayer may regularise their tax position, should they need to, is to make a qualifying disclosure. Tax law gives a taxpayer the right to make a qualifying disclosure to revenue if they find that they have a tax default. A qualifying disclosure is a disclosure that the taxpayer makes in writing to revenue, giving complete information in relation to all matters previously undisclosed that give rise to a liability to tax. It is a signed declaration that, to the best of that person's knowledge, information and belief, that all matters contained in the disclosure are correct and complete. It must be accompanied by a full payment of the tax and duty payable in respect of any matter contained in the disclosure and the interest on the late payment of that tax and duty, or a revenue-approved phased payment arrangement in relation to that tax, duty and interest payable. For more information, taxpayers and their agents are directed towards Section 2.8 of the Code of Practice. A taxpayer who makes a qualifying disclosure may benefit from having penalties mitigated, allowing them to regularise their tax affairs in the most advantageous way possible. A taxpayer who makes a qualifying disclosure will not be published on the quarterly list of tax defaulters, irrespective of the amount of the settlement. Revenue will not initiate an investigation with a view to prosecution in respect of a default where a qualifying disclosure has been made by a taxpayer. When a taxpayer comes forward and makes a disclosure to revenue without having received notification of a Level 2 or a Level 3 compliance intervention, their disclosure is an unprompted disclosure. A taxpayer may also make a disclosure in circumstances where they have received notification of a Level 2 revenue inquiry. In these circumstances, their disclosure is a prompted disclosure and must be made to revenue before the revenue inquiry commences. In order to make a qualifying disclosure, the taxpayer must disclose complete information in relation to all matters occasioning a liability to tax and pay the tax and interest at the same time as the signed written disclosure is submitted to revenue. On receipt, revenue will examine the disclosure, and where it is found to meet the qualifying criteria, the disclosure will be accepted as qualifying. The taxpayer will be notified in writing whether their disclosure has been accepted as qualifying or not. And in cases where a penalty applies, the penalty will be reduced where a qualifying disclosure has been made and the taxpayer has given full cooperation with any revenue intervention. A taxpayer who has received notification from revenue of a compliance intervention should take note of the level of intervention that they are being notified of. They should also inform themselves of the time frame within which they should respond to the notification should they wish to make a disclosure by consulting Chapter 2 of the Code of Practice. If, during a self-review of their tax affairs, a taxpayer believes that the area of tax is complex or that they may not fully understand their obligations, they may consider if they need expert advice. Once notified, if the taxpayer cooperates fully with all aspects of the intervention, where a penalty arises due to a tax default, that penalty may be reduced based on full cooperation given by the taxpayer. Where the taxpayer receives written notification of a compliance intervention, they may contact revenue using the contact details on the notification letter or through my inquiries if they require further information. Where a taxpayer has either received correspondence from revenue regarding a Level 1 compliance intervention, or where they believe they may fall into a category of taxpayer who is being asked to self-review an aspect of their tax affairs, there are several ways that the taxpayer can engage with revenue if they find they have a tax default. The taxpayer may self-correct a return they have previously filed, or they may make an unprompted disclosure at any time. If their case is subsequently selected for a Level 2 intervention, once the taxpayer receives notification of the escalated intervention, they lose their right to make an unprompted disclosure, but they do retain a right to make a prompted disclosure. If their case is escalated to a Level 3 intervention, they will not have the right to make a qualifying disclosure. There are two types of Level 2 compliance interventions: the risk review and the revenue audit. Revenue may open a Level 2 compliance intervention where a risk that is specific to an individual taxpayer has been identified by revenue. A taxpayer will be given written notification if they are selected for a Level 2 revenue inquiry. The revenue inquiry will commence 28 days after the date of taxpayer notification. Revenue advises taxpayers that if they receive notification of a Level 2 compliance intervention, they must act within a defined time period if they wish to exercise their right to make a prompted disclosure under a Level 2 revenue inquiry. If you receive a notification of this kind, you may make a prompted disclosure within the 28 days between the date of the notification of the Level 2 revenue inquiry and the commencement date of that inquiry. If you need longer than 28 days to prepare your disclosure, you may request additional time in which to do so. Your request for additional time must be made in writing to revenue within 21 days of the date on which you received the notification of the Level 2 inquiry. A maximum extension of 60 days to prepare a prompted disclosure may be granted by the revenue official handling your compliance intervention. Once a Level 2 compliance intervention commences, the taxpayer loses their right to make a prompted disclosure. They may still, however, benefit from penalty mitigation if they offer full cooperation during the course of the revenue compliance intervention. A revenue investigation is an examination of a taxpayer's affairs where revenue believes that serious tax or duty evasion may have occurred or that a revenue offence may have been committed. A revenue investigation generally commences once the taxpayer has been formally advised in writing that his or her tax affairs are under investigation. Once notified of a revenue investigation, the taxpayer will not be able to benefit from the opportunity to make a qualifying disclosure. A reduced penalty, however, may be considered where a taxpayer gives full cooperation with the revenue investigation. Under tax law, a taxpayer may incur a tax-geared penalty for a tax default where they have either omitted to file their tax returns or where they have carelessly or deliberately filed incorrect tax returns. The tax-geared penalty is calculated as a percentage of the amount of tax underpaid, or, in refund cases, the amount of tax overclaimed. The penalty rate applicable to a particular tax default depends on the category of default that has given rise to that tax default. The penalty rate may be mitigated where a taxpayer makes a qualifying disclosure and gives full cooperation with the intervention. Certain types of tax defaults do not attract a tax-geared penalty. Cases where the liability to tax is under €6,000 and the default arises due to careless behaviour on the part of the taxpayer. Cases where revenue accepts that the tax default is a technical adjustment, or cases where revenue accepts that the tax default has arisen due to innocent error. More information is available at section 4.5 of the Code of Practice. Under tax law, the category of default, by which is meant the behaviour of the taxpayer that gave rise to the tax default, will determine the tax-geared penalty rate that is relevant to that tax default. Taxpayers must exercise care in fulfilling their tax obligations. It follows that careless behaviour is a lack of due care that results in tax liabilities returned by the taxpayer being understated, or in repayment claims being incorrect. And so, careless behaviour means the failure to take reasonable care. There can be no indicators of deliberate behaviour for the careless behaviour category of default to apply. Examples of careless behaviour includes estimation of accounts items, neglecting to categorise expenditure into allowable and disallowable categories for tax purposes, neglecting to take advice on the issue of interpretation where either revenue or a tax agent should have been approached for guidance, and the frequency of the error made. A case involving an isolated error with minor tax implications will be viewed in a different light to a case with more frequent errors. For a tax default to be considered in the deliberate behaviour category of default, there must be indicators consistent with intent on the part of the taxpayer to actively present a lower than correct tax liability or to seek a higher than correct tax refund. Indicators of deliberate behaviour include failure to keep proper books and records required by law to enable the taxpayer's correct tax liability to be determined, repeated omissions or a large single omission of transactions from the books and records, omissions from tax returns, providing incomplete, false or misleading documents or information, claiming a refund of tax when not lawfully entitled to that refund, serious failure to operate fiduciary taxes, or the concealment of bank accounts or other assets. Statutory tax-geared penalty rates for tax defaults that are liable to a penalty are shown here on this table. As indicated, a penalty rate may be mitigated or reduced where the taxpayer gives full cooperation with the revenue compliance intervention. Furthermore, there is significant mitigation or reduction of the penalty rate when a taxpayer makes a qualifying disclosure, depending on the type of disclosure made. Where the tax default arises due to deliberate behaviour, the statutory penalty rate and the mitigated rates available to the taxpayer are shown in the first section of this table. Where the default arises due to careless behaviour and the tax underpaid is more than 15% of the tax correctly payable. In other words, it is a default with significant consequences. The relevant statutory penalty rate and the mitigated rates available to the taxpayer are shown in the middle panel of this table. For more minor tax defaults, where the liability to tax is over €6,000, but where the tax underpaid is less than 15% of the tax correctly payable, the relevant statutory penalty and the mitigated rates available to the taxpayer are shown in the final section of this table. Taxpayers may refer to section 4.6.2 of the Code of Practice for more information. Every taxpayer is required to pay their taxes by the due date. Revenue recognises that this is not always possible. You can avail of the option to pay your tax debts by phased payment arrangement, or PPA, which will allow you to repay your tax debts in instalments over a period of time. The maximum length of a PPA is 36 months. A down payment is required and interest is applied over the repayment period. More information on how a PPA is structured and how to apply can be found on Revenue's website. In conclusion, the Compliance Intervention Framework demonstrates the transparent approach that Revenue implements to ensure tax compliance is managed fairly and consistently within our tax system. The Code of Practice outlines in detail the rights and responsibilities of Revenue, the taxpayer and their agents in conducting and engaging with a revenue compliance intervention. Thank you for watching this informational video.